By the end of this video, you will be able to understand what is an asset book, how it links time and money, why one asset will have different values at the same time, how multiple asset books are used to track multi-value nature of an asset, how to create a corporate asset book and tax asset book, how to assign asset categories to corporate and tax asset books, create a fixed asset in corporate book, copy the asset from corporate to tax asset book, run the depreciation for next two periods for corporate and tax asset books, verify that net book value and depreciation for the same asset in the two books are different, understand how the whatever we are doing till now will understand how this achieves the shareholder and the tax authorities requirements in the real world. Asset value in terms of money reduces over time. Asset book is used to link money and time. It tracks the value of asset, that is money, over the period of time. In other words, asset book links time and money. If you buy a car for $30,000, the value of car won't be reduced suddenly. It reduces every year. As every year car becomes old, its value keeps reducing. Here is a graphical representation to explain the nature of the asset. Its value reduces over time. Asset book is a rule book that tracks asset value over time. Asset books links the money, that is value of the asset, and time together. In Oracle fixed assets, one asset can be tracked by different asset books at the same time. The reason is, in the real world, single car should have different representation of its value to different authorities. Let's say if an organization buys a car, its value should be reduced gradually over the entire life of the period, and that gradual reduction should be shown to the customer and in the financial reportings of the organization, so that the balance sheet and profit and loss statements remain healthy. Whereas for the same car, when an organization purchases a car for the improve its business, government give some incentives, right? It gives some encouragement to the organization, wherein organization can claim entire value of the car or its value in within few years of its lifetime as a tax exemption to the government. So the value of the car will be reduced very quickly from the perspective of the government, and that value we can show it to the government and get the tax exemption or tax benefits from the government. So single asset will behave differently. Its value reduction will be different from the perspective of companies asset financial reporting and from the perspective of tax or government IRS perspective. So as single asset is having different behavior of reducing its value, we need different asset books. One asset book will be corporate and another will be tax asset book. That's an asset book, money plus time tracked smartly. Now let us understand the multi-value nature of an asset in more detail, because this is very fundamental for fixed assets and we need to understand it very clearly, because that will be the foundation for all the fixed assets module. So single asset should represent different values at the same time for different stakeholders in the real time. Let us understand this concept with few real-time examples. Example 1. Let's say if you buy an item from any of the online stores, maybe Amazon, Flipkart or any of the stores, if you buy it for $154, actually the actual price will be, let's say, $145, and there is a tax of $9 on top of it, and the total amount that will be paying is $154. So for us, $154 is the truth, because that is what we are paying from our bank account. But for government, $145 is the actual value, because they calculate the tax based on this value, right? So the action is one, we are purchasing an item on the online store. For us, $154 is the actual value, but for government will look 145 as a base to calculate its tax. So activity is one, but there are different views of it. Similarly, let's look at another example. We get our salary every month, right? Let's say if a person is getting $10,000 as a salary every month, out of that he pays 401k and insurance. Let's assume $2,000, and this is similar to provident fund that we pay in India, and the remaining amount will be $8,000, and this amount is non-taxable, and the tax, government calculates tax on the remaining amount. On 8,000, let's say $2,000 is the tax, and net amount that gets credited into the person's account is 6,000. So here the company, for the company, the truth is $10,000 because it is what it is paying to the employee. And for the tax, government looks at the taxable income out of that, that is $8,000, and after taxes getting deducted, then only 6,000 will be gets deposited into our account. So here the activity is salary being getting credited, and if you see from employer perspective, it is 10,000. Government is calculating the tax based on the 8,000 amount, and the employee is getting 6,000 as actual amount in his account. Maybe 401k is something even that is getting deposited in his 401k account. But if you see as a whole, the activity is one, and there are different stakeholders in the real time, that is employer, employee, and the government, and each one is having his own view of it. Now come to actual fixed assets module. If an organization buys a truck for $30,000, then the result will be, in the organization the truck count will increase by 1 and cash will get reduced by 30,000. Now option 1, there are multiple options we will see in the next slides, but let us understand the first option. The 30,000 the organization can show as an expense immediately in the same period. If they do this, then the profit of the organization in the next quarter, right, will be reduced by $30,000, and this will impact the profit of the organization, and that will have impact on the share price. And but this presentation is not right, because we have spent $30,000 to buy a truck, but the truck is still with the organization. That is also an asset. So if you show that as an expense immediately, that is not a right presentation, and it will, that is not correct presentation, and it will impact the share price, and the books, the its value in the books is not correct. That is not a right representation. So let us look at the other option. If you buy the truck for 30,000, then the result will be the same. Instead of showing that 30,000 as an expense immediately, we can record that expense splitted over its entire life cycle. Let's say if the life of the truck is 5 years, then for a year it will be $6,000, and per quarter for 3 months it will be $1,500. We can show only $1,500 as an expense for each quarter, so profit reduces by $1,500 in the present quarter instead of 30,000 in when compared to the previous way of representing this transaction. Then there will be very less impact, and the value presented in the books will be right, and shareholder will be happy, and company health will be financial health will be shown correctly. This is what we are trying to achieve in the fixed assets module. And for the same truck, there is different aspect of it. Now in the previous slide we have seen the shareholder aspect, or company's reporting books aspect. Let us look from the government aspect. So each organization, when they buy a fixed asset, that is not for the immediate revenue. Let's say if an organization buys raw material, then they will, maybe in the short period of time, they will process that raw material and they will make a product, they will sell it, they will get the revenue, make profit out of it. But when they buy a fixed asset, it is not an immediate profit generating activity. They are buying that to support their business, to expand their business. In one way, organization is expanding its business, and it's helping the government as well, because when organizations expands their business, that's where they generate employment opportunities. That's where they will help in the growth of the economy of the nation, right? Because of that, government will give incentives when an organization buys a fixed assets, and then when they improve their business, when they expand their business. So some possible kinds of incentives will be, uh, they will, like, every organization has to pay the taxes, right, for the revenue that they get. So when they buy something, uh, some fixed asset and expanding their business, government will give them whatever you are spending in buying the fixed asset, that you can claim as a tax deduction. It's the same, let's say in our salary, if you are paying some life insurance, if you are in India, if you are paying life insurance yearly, let's say $30,000, that we can claim in one of the section in the tax, right? It's similar to that. So companies can claim that amount that they have spent on fixed asset, that their revenue can reduce by that amount, so that they will pay the tax for the remaining revenue. So for because of that reason, even though if the life of the truck is 5 years, based on the category of the fixed asset that we are buying, government will give a list for this category. Even if the actual life is 10 years, you can treat that as 2 years, and then you can put its value in 2 years, and then you can claim the tax benefit out of that. So let's say for this truck, if government says you can claim entire amount in the first year, then we will record 30,000 as an expense, and that meets the IRS. Here I am talking about Internal Revenue Services in US. It meets the IRS guidelines as well. We can record it. This is right way of recording, and we can claim that 30,000 has benefit from tax payment. If our total revenue is 2 lakhs, out of that we can reduce 30,000, that then it will be 1,70,000 will be our revenue, and we can pay the tax only for 1,70,000 in that year. So that way company is getting benefited, government is encouraging the company, and this will be current presentation or current recording of the value from the perspective of the IRS. So for, as there are multiple perspectives, one from the shareholder and company's books perspective, which we have seen in the previous slide, and this is another perspective from the perspective of government. This is a second representation. So this is even better representation. One fixed asset, it will have two views. One view is from the shareholder or company perspective, and another will be from the IRS or tax authority perspective. So the value depreciation will be different. To track this view, we need a corporate book. To track this view, we need a tax book. So same asset will be created in the corporate book, and it will have one level of depreciating, whereas then same asset will be copied from tax book, corporate book to tax book, and it will follow a different depreciation method, and it will depreciate very fastly. Here it meets the company and shareholders requirements, and it meets the government requirements. Here is a graphical representation. So same asset from the corporate books, it declines very slowly in a straight line over the entire life of the asset, whereas this is in tax book, because government is giving some benefits to the organization to claim that spending that we are doing on the fixed assets has a tax reduction, or we can claim as in the tax returns. So its value will be reducing very quickly, and company will get benefit out of that. So now we will get into a practice in Oracle Fusion, where we will create a corporate book with the name SM US Corp, and we will create a tax book with the name SM US Federal, and we will assign a asset category vehicle heavy to about 2 books, and then we will create an asset in SM US Corp asset book and copy it to tax book, and run the depreciation and close the period for the both the books. And we will do the same activity. We will again run the depreciation and close the books for the next period as well. and we will verify that the net book value of the asset and the depreciation is different in the both the books for the single asset. To create an asset book, go to setup and maintenance. Select financials offering, fixed assets functional area. Select manage asset books. Before we create an asset book, let us see an existing asset book and understand the structure of it. Select associate corporate book as US Corp. Click on search. Click on US Corp book. See that this page has two sections, one on the left side and one on the right side. This left side we discussed earlier, right? Asset books links time and money. In this left side we are tracking the time. If we see here, we have the depreciation calendar and fiscal year. So this is the time with a subset of it that will be governed by what is the calendar that we are using. Is it monthly calendar, daily calendar, or quarterly calendar? And this asset book will be always linked to a ledger. And on the right side of it, it will decide what are the controls this asset book will give to the fixed assets. So I'm not going in detail of the each. You can have a look at it, but main things are here. Yellow ledger posting, this will be checked for corporate books if you want to post the data to GL. For tax books we won't check it because tax books are for tax authority purposes, not for shareholder or company books purposes. So this will be unchecked for tax books. And the tax or corporate book will be decided by book class. And if you want to enable approvals for fixed assets, we can check this. We can select here for which action you want to enable that. And this section of the asset books will talks about money aspect of it. When any transaction is performed on the fixed asset, into which accounts the change in the value of that asset has to go into. And on very high level, these first few accounts, these two accounts talks about how which accounts should be affected when we retire an asset. And while we are retiring, if we sell it to, instead of scrapping it, if we sell it to someone, which account should be affected. And if we scrap it and we will, if we remove that scrap from our organization, how which accounts should be affected. Yeah, these are the main accounts. And when during revaluation, when we revalue an asset, what account should be affected, this will be provided here. And there are other tabs here. You can see these are advanced rules and invoicing rules. This tab tells about how this asset will be linked to AP invoice. If assets are created from AP invoice, how those two are linked. And if when we do revaluation, those controls are given here. So this is high level the structure of the asset book, where we have time aspect of it, controls of the assets, and then money aspect of it, into which accounts they has to go into, and link to AP and revaluation of the asset. Now we'll create an corporate asset book first with name SM US Corp. Click on create icon. I'll enter the data in the interest of time. I have entered the required information. This is a corporate book for US primary ledger, and the starting period is January 25. And I have entered the accounts also. When you are creating, maybe you can copy the accounts that are being used for existing asset book that is under US primary ledger. Click on save and close. Similarly, let us create a tax book. I have entered the required information. Oh, I have selected book class as corporate. It should be tax. Let me change that. Associate corporate book will be SM US Corp. Yeah. Go to tax tab. yellow mask copy, select all the checkboxes. This is not mandatory. Click on save and close. Now we have created a corporate books and tax book. Let us search if they are available. I have entered ledger as US primary ledger and clicked on search, and now we can see SM US Corp and SM US Federal. These are the two asset books that we have created with book class as corporate and tax. Now to create assets in SM US Corp asset book, we need to associate at least one asset category to this asset book. So click on done. Go to task manage asset categories. Click on manage asset categories. Click on search. Select the category heavy vehicles. Click on edit. Now let us associate this category to SM US Corp and SM US Federal books. Click on plus icon under books. Select SM US Corp. Enter the required information for accounts. I have entered all the required accounts and go to defaulting rules. Click on plus icon. Here we have to select the depreciation type. So for corporate asset books, the depreciation type will be standard line STL and will give the life as 10 years. It's straight line depreciation method and life of the asset is 10 years. Prorate conversion will give calendar month and retirement conversion as well. And remaining fields are optional. Let us click on save. Let us assign the same category to tax book that we have created. Click on plus icon. Select the asset book as SM US Federal. This is the tax book that we have created. Book class is tax. And click on plus icon. Under accounts section, let me enter the data. I have entered the required accounting information. I'm selecting depreciation method as MRCS half year convention 100% bonus. Even I'm not sure how this will behave, how quickly the depreciation will be. Let us select this, and when we test it, we will see how it behaves. I'll give life as 3 years, and the life is 10 years in the corporate book. In tax book, I'm keeping only 3 years, and we'll give this prorate conversion as half yearly, whereas in corporate book we give monthly. Click on save and close. Now the next step is to create the asset in the new asset book, but to do that, first we should give access to the user to the asset book. To give access to the user to the asset book, click on users and security. Yeah, I have entered the asset books, and let us click on save and close. Click on done. Now go to fixed assets application. Go to home page. Click on assets and click on create asset icon. Add asset. Now change it to SM US Corp. This is the corporate book that we have created. Now if you see category and location flex fields are grayed out, it means these flex fields have some issue. Might be some other person might be working on it, and they might not have saved the compilations. Let me fix this and I'll come back here. While fixing the KFF issue, the instance got refreshed, so I have created all the setups again in a different instance. Let us create the fixed asset. Select the category. Let us give the description as truck. and cost of the asset has 30,000. Select a location, click on next. Let us give the asset number as 301. Select an asset key, click on submit. Now the asset is in ready to post status. Select it and click on post all. Click on ready to post. If it is done, it will become 0. Now asset has been created. Let us query the asset. Go to inquire assets. Asset number is 301. The asset has been created. The cost of asset is $30,000. Click on done. Now we need to copy. Now we have created that in the corporate asset book. We need to copy that to tax book. In another tab, select the asset book as SMUS Federal, which is the tax book that we have created, and click on copy from corporate. Now this will copy the asset from corporate book to tax book. It may take a couple of seconds for the program to complete. Let us query that asset. Click on inquire assets. Asset number is 301. Now if you see the asset number that is available in both the books, SMUS Corp, COP and Federal. Click on done. And if you see now, depreciation is not yet run. So for both the books, corporate and in Federal, we don't see any depreciation data populated. So the next step is, for the January 25 period, we will submit the depreciation process in both corporate and in the tax books. In the corporate book, now we are in corporate book. Click on this infolet depreciation. Click on calculate depreciation. Similarly, in the tax book, go to the page, click on the infolet and click on calculate depreciation. Now let us query the asset and see if the depreciation data got populated. Click on inquire assets. Query for the assets. And now we are in the corporate book. Click on depreciation. Yeah, it is not yet populated. No, maybe the schedule program might be still running. Let me check that. Now depreciation got populated. For asset number 301, when we select the corporate book, for January period, it is $250. If you select the tax book for the same asset, and in January period, it is $2,500. This difference is because we have selected a different depreciation method and even different life for the different asset books. Now let us close this January period and then run the depreciation for February period. To close the period, let us close first corporate book period. Now we are in the US Corp book. So before that, let us submit the create accounting for the corporate book and then we will close the period. Click on create accounting. Select the book as SMUS COP. I mistakenly kept it as COP instead of Corp. Include user identifiers, yes, till 1st Jan 25. Process category will leave it blank so that it will pick all the transactions. Click on submit. In another tab, let us wait for this program to complete. It has just submitted and it is in running status. Now the create accounting for assets has been successfully completed. So we can close the period. Now we are in SM corporate book and click on the info let depreciation and click on close period. Yes, we want to close the period, and this closes the corporate book period. Now in another tab, let us close the tax book period. For tax book, we don't need to run create accounting because we are not sending that data to GL books. This is only for the purpose of tax authority. So we don't need to run the accounting process. Even if you remember, while creating the asset book, we have selected um, post data to subledger journal GL. That checkbox we didn't check because accounting is not required for tax book. So will not run the create accounting process. We'll close the period directly. Click on close period. Yes. Once the period is closed, it opens the next period. So let us refresh. Let us go to navigator and we'll go to the fixed assets application and come back so that this period will get changed from January to February. Now it got changed to February. Similarly, let us do the same for US federal as well. Yeah, even for US federal, this got changed. Now let us run the depreciation for Feb period as well. In the corporate book, click on calculate depreciation. Similarly, in another tab, let us run the depreciation for tax book. Select the tax book, click on the infolet, click on calculate depreciation. Now we will query the asset and see that depreciation got populated. Click on inquire assets, query the asset number 301, click on search, and for the asset 301 in SM US car book, the depreciation populated for January and February period, $250 each month. And for federal tax book, and it is populated for both January and February, but $2,500 for each month. Now you can see the difference. Same asset tracked in corporate and tax books, and the rate of depreciation is different. As we discussed, this is for different purposes. This amount will be used to claim the tax benefit while filing quarterly tax returns. Now let me put it in a PPT so that this will be useful for our understanding. Here is the table I have prepared. The asset 301 in the corporate book, for each period the depreciation is $250 and net book value is reducing by 250 each month, and like after 3 months it will be 29,225. Whereas in tax book, this is the entries for tax book, and that is they're reducing by $2,500 because depreciation is 2,500, and this is how the net book value will be. By the end of the quarter it will be 22,500. So now the final question comes, how this tracking is used by the company, right? At the end of each quarter they will be filing the tax returns to the government where they will be paying the taxes. Let us assume the company made a revenue of $2 lakh in the quarter, and the expense is $1,50,000, and the profit is revenue minus expense, that is $50,000. On the profit, the organization has to pay the tax to the government. And in the beginning of the video I said it is on the revenue, but it is not on the revenue. It is company has to pay the tax on the profit. Let's say, as for government rule, if it is 20% of the profit, then they has to pay $10,000. But this is normal scenario when they didn't purchase any fixed asset. Let's say if they purchased a fixed asset, in this scenario they have purchased one fixed asset for $30,000 and there is a depreciation of $7,500. So the profit will be uh, this, right? Profit is $50,000, but the taxable income will be reducing. Let me copy this. Profit is $50,000 only, but the profit we are not going to calculate directly on $50,000. The tax we are not going to calculate directly on the fixed on the profit. We will reduce the depreciation of the fixed asset from the profit, and then that will be 42,500, and 20% of tax will be calculated on top of 42,500, and that will be equal to 8,500. Because of fixed asset that we have bought and because of the depreciation as per other government norms, we have saved a tax of 1,500 in that quarter. This is how I try to put together the real time and then Oracle, so that I hope it has given you a overview of why we are doing this in the fixed assets module, and how it will be used by the government to file the tax returns and get the benefit out of that. If you find this video helpful, like the video and subscribe to my channel. Thank you for watching. In the next video we will be looking at asset categories in Oracle fixed assets. Thank you.